For decades, money market funds were stuck in mutual fund land. You had to wait for end-of-day pricing, your money sat with a broker overnight, and intraday liquidity simply did not exist. Last summer, that changed. A new ETF launched that gives you institutional-grade money market exposure with the trading flexibility of a stock, and it has already gathered $4 billion in assets. The fund is the Simplified Government Money Market ETF, ticker SBIL. It launched in July of 2025, charges 15 basis points, and was one of the first U.S. ETFs to use a floating net asset value structure on a true money market portfolio. As of late 2025, the SEC 30-day yield was hovering around 3.9%. Here's what's actually inside. SBIL invests at least 99.5% of its assets in cash, short-dated U.S. government securities, and overnight repurchase agreements collateralized by treasuries. There is no credit risk to corporations, no exotic structures, and no duration to speak of. It is, by design, the boring corner of your portfolio. So why does this matter? Compare SBIL to a traditional money market mutual fund. With a mutual fund, you can only buy or sell once per day, at 4 p.m. Your cash is essentially frozen during market hours. With an ETF wrapper, SBIL trades like any stock from 9:30 to 4 p.m. Eastern, which means you can move into and out of cash in real time as the market moves. For active traders, that flexibility is enormous. Now here's what they don't tell you. The yield on SBIL is not a guarantee. It floats with short-term Treasury rates. When the Federal Reserve cuts rates, the yield drops the next day. The current 3.9% yield reflects today's rate environment. In a different cycle, you could be earning 2%, or 1%, or 30 basis points like in 2020. There is also a tax angle most retail investors miss. Treasury income earned through SBIL is generally exempt from state and local taxes. If you live in California, New York, or Oregon, that exemption alone can be worth a meaningful boost in after-tax yield versus a corporate money market fund. But you should confirm with your tax advisor. And the floating net asset value matters. Unlike a stable $1 money market fund, SBIL's share price will move slightly day to day. In 99% of conditions, that movement is invisible. But during a stress event, the price can drop a few cents below par. That is by design, and it is a feature of the regulatory structure, not a flaw. So who is this fund for? It's for cash-heavy investors who want competitive yield and stock-like liquidity, for taxable accounts in high-tax states that benefit from the state tax exemption, and for traders who park cash between trades. It is not a substitute for a savings account at your bank, and it is not the same as a stable NAV money market fund. One honest reality check. SBIL is not a portfolio. It is a parking spot. 3.9% on cash is competitive today, but inflation, real returns, and your overall asset allocation should still drive your bigger investment decisions. This is one tool in the toolbox, not the toolbox. If this breakdown helped you, hit like, subscribe, and tell me in the comments. Would you swap your traditional money market fund for an ETF version like SBIL, or is the stable $1 NAV non-negotiable for you? I read every comment, and the best ones shape the next video.